You know the old saying, as January goes, so goes the whole year. How January goes is going to be dependent on how that first week of trading goes in the new year as well. So we started off on a good foot on the first day of the trading year, but from there it was all downhill, especially when the FOMC minutes came out on Wednesday, where you just saw a torrential sell-off that carried us into the end of the week. For the week, the S&P 500 was down 1.9%, down 4 straight days in 4 out of the last 6. And then you had the NASDAQ Composite and the NASDAQ 100. It was down 4.5% each, down 4 straight days and 8 out of the last 9. That's a lot of selling in those tech stocks. Then, of course, you have the Russell 2000, your small caps. They were down 2.9% and 5 out of the last 7 trading sessions. We're seeing a start to the year that's seeing a lot of money flow out of the tech stocks and into energy and financials and even some of the material plays as well. You saw some strength up until that FOMC statement came out on Wednesday, and your copper names, aluminum, steel. But as the week wore on, they started weakening a bit and more money started flowing into the energy and financials instead. There was very little interest in tech all week long. And that's to be expected because as we get closer and closer to the tapering, there's going to be less and less asset purchases by the Fed. The tapering will have been completed, and you're looking at your first interest rate hike, which is never a good thing for tech stocks as a whole. But you know who does benefit off of that? The banks. Let's go ahead and dive right into the chart. You're looking at the NASDAQ 100. QQQ is the symbol. You have this nice rising channel that's in place. Now, what do you notice here? It hasn't broken it yet. Okay, with all the selling, 8 out of the last 9 days, we haven't broken this declining channel. So a lot of people are saying, hey, the top's in this market. We're going to see this big stock market crash, button down the hatches. But they're front running the actual crash that they're thinking that's going to happen here. Until it happens, you can't say there's a crash underway. And right now, yes, you do have a topping pattern that's forming. You have a double top here. You also have a key support level right at the 377, 378 area that, if broken, could spell a lot of problems for the NASDAQ. If it breaks, you better hope that this rising trend line is still in play because that could offer a little bit of support for the market as well. Because when you go back, you can see time and time again, we have tested it and held it, leading to significant bounces, usually to new all-time highs. That goes all the way back to November of 2020. So there's a lot of historical importance on this rising trend line. But this topping pattern here, it's not just unique to the NASDAQ. It's also seen in Microsoft. Microsoft actually confirmed the pattern, but it hasn't broken its channel either. And you can see this channel is even more impressive going all the way back to March 2020, not just November, March of 2020. And so far, it's holding that rising channel. So there's no precedent yet to say, hey, this channel is breaking. Google, another very similar topping pattern here. Yes, it's confirmed it as well. It broke below it last week, especially with the FOMC minutes when it came out. But again, you have this rising channel, not as well defined, but we're still holding it here. It has been a long time since it's tested it. It's been more than a year. Now it's being tested again. And it's going to be very key going into next week that it holds this trend. Because if we see it breaking Google, if we see it breaking Microsoft, and we see some more selling in Apple, then yes, I expect that we're going to see it also emerge in Qs because the market caps in those 3 stocks are massive. I mean, we're talking about $7 trillion of market cap there. If those 3 continue their breakdown, you're going to see the breakdown continue in the NASDAQ as well, likely leading us to a setup or a retest of the lows that were established back in October. But remember, just because we're testing a short-term support doesn't mean that it has to break. Oftentimes, we've seen these head and shoulders patterns in particular, and this isn't necessarily a head and shoulders pattern, it's a double top, but we've seen a lot of these patterns that form these strong support levels in the short term not break and instead become rallying points for the bulls to circle their wagons around, and they go shooting straight back up to those all-time highs. Now, look at it from the weekly chart here. This also is going to give you a good understanding or a better understanding of where we stand in this current market rally. Long-term channel going back to November of last year. Still in play. And if you look at it from the weekly standpoint here, it doesn't look that bad. It looks like, okay, it had a bad week here, but we're not breaking down yet. So this rising channel, very, very important going into next week. Now, let's look at the SPY. The one thing that's been in play on SPY going back more than a year now, and it looks like it's going to be in play here going into next week, is this 50-day moving average, this red line here. It closed just below it, but that's not enough to say, okay, It broke the 50-day moving average. Go ahead and sell all of your stocks. This S&P 500 is going to continue to sell off. No, because what we've seen time and time again is we can break this 50-day moving average and immediately recapture it the following trading session. So just because we're trading below it today doesn't mean that we'll be trading below it on Monday. So you want to be very cautious around this 50-day moving average. I even trimmed my short exposure this past week simply because I didn't want to be exposed to another market bounce. Didn't get out of all of it, but I did trim it some. But when you go back, look at this history with the 50-day moving average. Again, you have it in July. You have it in June. Notice in June, we break right below it, and then we rally straight back up. Tested it twice in May, held it each time. So this is a huge, huge support level. Again, March, twice in March, actually, February. This is an important moving average that the bulls continuously bounce off of. We tested it on Thursday. We tested it on Friday. Yes, we closed below it on Friday. Doesn't mean that it's necessarily breaking down from here. So you want to be very cautious with your short positions. You don't want to just go blindly buying longs here. If you're going to get long, you want to see first that it has a willingness to bounce off of that 50-day moving average, which we have not seen at this moment. And like the Qs, let's take a look at SPY on the weekly chart. Again, the trend line's still intact, guys. Still intact. It's got a short-term price support level that it needs to hold as well if this channel is to break. If that channel breaks and this support level, that one breaks, okay, then you got some big problems on your hand. But that hasn't happened yet. So getting extremely bearish at this point in the market is very premature. Instead, trading a little bit lighter is definitely a good idea. Waiting to see if the market wants to bounce, an even better idea, because if you start to see it bounce, you're going to be light on the market, and it's going to give you the flexibility to be able to get back to the long side. If it doesn't and it breaks down, well, then you can either raise more cash or get short on the market. It's just as simple as that. I mean, you look at the monthly, yeah, incredible ride. I mean, it's insane. But again, this past week, or the monthly price action that we're seeing so far in January, looks like a blip on the radar. IWM on the monthly chart looks like a bull flag pattern, right? Looks like, okay, off to a rough start in January. Had a pretty rough November, but nonetheless, it's still bull flagging. Now, you zoom in a little bit to the weekly chart here. Yes, you're starting to see more of a topping pattern that's developing here. Definitely something to be concerned about. It's nearing some key support, and you see it even more so on the daily chart where it has consistently tested the support level. We got 1, we got 2, we got 3, 4, 5, and 6 times. The last 6 times it's tested this massive support level, it is held. So what does that mean for going into Monday? It doesn't hurt to tread lightly here, because if we test the support level when we start to bounce, it could bounce really fast. So you're going to want to be cognizant of this 212, 213 level on IWM, that if it holds on Monday, or if it holds on Tuesday, or at some point next week, and it starts to rally hard, that's going to be your sign that you might want to increase your exposure in small caps as a result. Now, the takeaway and all this is there's a lot of people screaming tops in the market right now. The people are saying that stock market crashes is going to happen. Does that necessarily mean you need to buy into it just because everybody else is? No, you don't need to do that. What you need to let happen is price confirm these levels that I've laid out for you. Okay, we know what it is in the Russell. We know what it is in the Qs, and we know what it is in the SPYs. We know that when we zoom out to the weekly and when we zoom out to the monthly chart, long-term trend patterns are still intact. Yes, we're seeing a lot of breakdowns in tech, in the software industries, but the market as a whole is still intact. You're seeing a lot of money flowing into energy, and you're seeing a lot of money flow into financials. I actually had a pretty good week this week just because I was in energy and short on the small caps. That helped me out tremendously. It didn't mean I didn't have any losing trades. Of course I did. I got into FCX, sucker head fake, man, I lost 4% on that trade. But I managed the risk on that, which allowed for my profitable trades to run wild and to create a lot more profits to offset the losses that I took in other trades. And guess what? I was only 50% right on the week, and I was still able to be profitable. Now, along the way, I trimmed some of those profits in the energy sector because guess what? I want this thing to keep going up for as high as it possibly can. But I also know that the reality of the matter is that there's going to be a pullback in energy at some point, in the future, and I don't want to be losing all the profits that I worked hard for. So I trim my position along the way, and I'm probably doing it a little bit more aggressively considering the market conditions that we've seen over the past couple of weeks. And I did the same thing with my short on the small caps. I trimmed some of the profits off of that. I wanted to make sure that if the market does bounce next week, and there's a good chance that it could because we're approaching some key support levels, and there's a good chance that dip buyers will still want to try and buy this dip, that I want to make sure I walk away with some profits there as well. If you enjoyed this video, I encourage you to like and subscribe. Also, make sure to check out my YouTube channel membership by clicking the join button below. You're going to get all my market research each and every day. I highly encourage it. It's an incredible asset, and it supports this channel to continue its growth. Please let me know down in the comments below, how was the start to 2022 for you? Are you off to a shaky start? Are you a little bit concerned that you're going to lose a lot of money this year? Or are you pretty optimistic about the market's direction and where it's going to take us? Let me know down in the comments. Thank you guys, and God bless.